Who doesn't dream of owning a home? A place with a garden where you can have a barbecue, spend time with friends or family. But owning a house isn't always as good as it seems. Why? Let me tell you why. At the beginning of the 2000s, the dream of home ownership had turned into a trend in America. Housing prices were rising constantly. And this rise didn't just affect the real estate market. It also created a sense of confidence in the entire financial system. People had come to believe that buying a house could never go wrong, that it was the fastest way to get rich. But this rise was quietly laying the groundwork for serious problems that no one yet noticed. Banks were taking on more and more risk, handing out loans to everyone. High credit score or low, it didn't matter anymore. And during this period, a new mechanism came into play: subprime mortgage loans, loans given to high-risk borrowers, people with unstable incomes or poor credit histories. But the risk didn't end there. Banks began to package and classify these loans according to their risk levels, and then sell them to investors or institutions looking for profit. These packages were known as CDOS, collateralized debt obligations. Complex financial products made up of thousands of risky mortgages bundled together. In reality, many of these debts were never going to be repaid, but greed blinds people, and it blinded the system. At the same time, low interest rates and abundant liquidity pushed not only banks but the entire financial world to take on more risk. Everyone, from individuals to major institutions, was convinced that housing prices would rise forever. Profit had replaced reason. And when greed joined the mix, society as a whole was moving forward without thinking about the consequences. Remember this. Financial systems are not just about money or instruments. When human nature drifts away from rationality and acts only on primal emotion, the system becomes most dangerous. By the end of 2007, the effects of that greed began to surface. Housing prices started to fall in some areas. Mortgage payments began to default, just as everyone should have expected. And trust between banks started to crumble. In September 2008, one of the giants of global finance, Lehman Brothers, an investment bank that offered asset management and financial advisory services, declared bankruptcy. This wasn't just any company collapsing. It was the first shockwave of a system-wide collapse. Because financial systems are fragile. A single failure can shake the entire structure, especially when the failure is this big. The bankruptcy created a domino effect. Banks stopped trusting each other, credit froze, and the financial system came to a near standstill. The crisis didn't stay contained within the United States. These toxic financial products had been sold to investors all over the world, to banks in Europe, funds in Asia, even institutions in developing countries. As a result, global trade nearly came to a halt. Millions lost their jobs. Millions more lost their homes. Trust in financial markets, much like in the fall of Rome, began to erode from within without the need for an external enemy. Rome had destroyed itself under the weight of its worthless currency. The modern world was now paying the price of a money-driven economy and growth without real production. Of course, the crisis wasn't caused by the housing sector alone. There were other reasons as well. Credit rating agencies rated risky assets as safe. Lack of regulation prevented oversight of complex products. Financial engineering made risk invisible. When you add greed and human psychology to the mix, the outcome was inevitable. As the crisis deepened, unemployment in the U.S. surged. Millions lost their homes. Economic growth stalled. Global trade slowed. Many countries entered recession. Banks suffered enormous losses, some collapsed entirely, and millions of people suddenly found themselves poorer. Above all, the feeling of trust, the foundation of any economy, was shattered. The same loss of confidence that destroyed Rome's economy was now repeating itself in the modern world. What began as a housing crisis in 2008 became one of the greatest economic collapses since the Great Depression of 1929. Consumption declined, investment halted, and the global economy took years to recover. Lessons from the 2008 crisis. Greed is dangerous. Regulation and oversight are always critical. Financial products must be understood, not blindly trusted. Economics cannot be separated from human psychology. There's no room for emotion in financial systems. In short, no matter how complex finance becomes, at its core it depends on human behavior, ethical responsibility, and strong oversight. The 2008 financial crisis showed us clearly that a strong and lasting economy is not built on numbers alone, but on conscious decisions and sound institutions. The 2008 crisis was not just another economic downturn. It was a moment that forced the world to question the very values and assumptions of modern capitalism. For the first time, people realized that the market does not always fix itself. This period also revealed that governments could not stand by and do nothing. The U.S. and other nations announced multi-trillion-dollar bailout packages to rescue banks. These steps may not have fit the principles of free markets, but they were the only measures that prevented total collapse. In other words, capitalism could only save itself with the help of the very state it often sought to limit. The crisis also showed how overgrown the finance-centered economy had become. Instead of real production, the system relied on financial products, paper profits, and speculation. People wanted to make money from money, not from creating real value, and no structure built on such weak foundations can stand for long. After the collapse, many countries tried to reform their financial systems, strengthen regulations, and reduce risks. But human nature doesn't change easily. Even today, we can see similar risks emerging in different forms. Lessons from past crises are often short-lived. As markets rise again, memory fades, and the perception of risk weakens. In the end, 2008 reminds us of one timeless truth. Economies don't stand on numbers alone. They stand on trust, responsibility, and morality. Money may have a universal language, but its true value depends on the conscience of those who use it. If a system turns its back on human values, then behind every rise, a collapse is inevitable.